as I said, generally moving down. The key points that you see on the predicted moving average are those points at which the market is going to cross over those. We have some key spots here where the market moves. The blue line crosses the black line, the actual moving average, which indicates a long a buy type of situation. And then you have another crossover here where you have the market crossing lower. Now, in this case, the predicted moving average kind of waffled back and forth a little bit. It makes it kind of tough to trade a trend like this simply because it is moving back and forth, and it is potential for giving you some problems if you're into a market and unless you're a very nimble trader trying to trade on a short-term basis. A couple of other indicators now that we're going to add to the mix to try to help us get through that issue. First of all, we have the predicted Neuro Index. The predicted Neuro Index is this gray line that you see on the screen on the bottom panel. If it is at 1, that is bullish. What that means is that it is a comparison of two 3-day moving averages, a predicted moving average and an actual moving average. If the typical price in 2 days is forecast to be higher, you get a reading of 1. If the typical price in 2 days is forecast to be lower, you get a reading of 0. So it's either 1 or it's 0, which means the short-term basis is bullish or bearish, no question about it. You don't have any question about what that indicator is telling you. Now, the other indicator that is on the bottom part of that screen are what are called the predicted differences. The predicted differences compare the predicted moving average with an actual moving average. We have a blue line. The blue line is the medium-term moving average comparison of the two. The green line is the long-term moving average comparison. So following those, you get a sense of the momentum of the market. When the market is starting to pick up a bit of steam, you will normally see the blue line and the green line eventually come together, but the blue line is going to accelerate, jump out of there faster, as it does in this point right here, jump out of the lows faster and turn faster than the long term. So that's an early alert. It's before even the predicted moving average above has turned, and those turns provide early alerts to be prepared for some change in direction, some change in momentum in what is going on with the market. Now, the predicted differences, they also have a couple of readings from them you can make. First of all, you want to note just basically the angle of it. Is it moving up? Is it moving down? And you can see that it was moving down recently. So is it moving up? Is it moving down? That's one of the keys with the predicted differences in conjunction with the predicted moving average. And what that kind of means is that the moving averages are widening apart or coming closer together. The crossovers, you can see that we have right here. We had a crossover here which indicated a move to the upside, a short-term move to the upside. We had a move here indicated a short-term move to the downside. So that's an important indicator. Also, with the moving or predicted differences, an important gauge here is this 0 line. If the lines, the predicted difference lines, are above the 0 line, it means a strengthening type of a situation, and the market, may not be going anywhere too much, but it's still got some strength in it, indicated by the movement above the 0 line. And if it is weakening, it will be below the 0 line. So all of those things are factored into an analysis of when we're looking at the prices and what to expect. I mentioned before, we were talking about the situation with corn. We had our big drop January the 12th, because that was another report that you had to play around with. Again, the question, did USDA get it wrong? And then wonder, well, if you have a lot of smart traders out there, how could they be wrong, and how could they misinterpret what the numbers are, what the crop looked like out there? How could they get it wrong? It's possible, and you can see that we most recently had another surprise. But we're going to go back now and take a look at a little bit more what we have on the screen. We're going to add another indicator and try to come up with a more precise point at which we're going to trade. What we have with the information that you see on those charts is we have simply a indication of direction. That's kind of, we know kind of the direction that we want to be. If we're trading corn at all, we want to favor the primary trend, which is down at this point. So it's kind of like, kind of the long-term forecast. You kind of want to look ahead, but maybe not the most reliable. So we need a shorter-term forecast to be able to find some precise points at which we're going to be able to trade. Now, to do that, we're going to add another vantage point indicator to the mix, and that is the predicted highs and the predicted lows. What vantage point does is, based upon intermarket data, the influence of the other markets, and what is going on, it is able to forecast one day ahead the predicted high and the predicted low, which provides a range for the next day's trade. It's important that when you look at that range, that we added a lot of numbers here, but these numbers can generally will confine most of the trading action during a day, but there are points at which it's going to break out and at which it's going to become very important to use that. Now, we're going to cut back our time. We have the longer term frame in mind, but we're going to cut back to 2 months so we can analyze this chart a little bit better, get some more precise look at some of the numbers, and talk a little bit about how to position for what you see on that far right screen. Is that that long white bar that we had, or white candle that we had over there on the right hand side of the screen, and how it got to be there, and what we would do about that if we were preparing for a trade. Again, we're looking again. Let me get my little things lined up here, and looks like we got them all. Okay, what we're looking at here, we're going to try to focus on the most current time, because we don't have time to get into every little squiggle and that we might have had, but we're going to focus on the most recent time here in our analysis and try to figure out exactly what we would have done. You can see that we had a situation previously. Just a quick note here, prior, this particular black candle that you see there was on May the 28th, and that was before the long holiday weekend. To me, that indicates, when you see that kind of a move, that the traders they're reluctant anyway, do not want to be long over a long weekend, and that's simply because at the time everything was fairly favorable in terms of the crop going into the ground, the outlook for the crop, that type of thing. So they didn't want to be long, so they got short, big black candle to the downside. Now, the way we would handle that if we were trading it and trying to set up for that is that we would look for the predicted low on this particular day, and we would fade it. We're going to use 6 cents as our kind of our measure of that we want it to go below, simply because we don't want to get caught by some kind of a jab or fake out move or whatever. So we're going to make a price go 6 cents below the predicted low before we're going to go short, simply because we don't want to be in too early. And we're using 6 cents because